Let's get started. So, the answer to the question, where am I trading? The exchange. What is an exchange? Marketplace where assets and financial instruments are traded, right? So, everyone goes there, meets up, buys, and sells. Simple to understand, no? Perfect. So, let's talk about these exchanges. An exchange can be a physical place, an electronic platform, or both. Okay? The New York Stock Exchange, for example, they have their own building. The Nasdaq has their own building, and they also operate electronically, right? But then you have exchanges that are just online. Let's say cryptocurrency exchanges, like this famous Binance, Poloniex, whatever, and they just exist as a platform, right? So you can log in online and do your trades. So they are very different from each other. But remember one thing. Not always we are trading on the exchange. Regardless if you think you are trading here, you're likely not. And I'm going to explain to you why. Look, first, for shares to be listed on exchanges, as an example, they have requirements, right? So think about it 1 second. If I just went ahead, I'm Stefano, I'm going to open a company, right? I go to the register, I register my company, and then I say like, oh, great, I have a company. What does it do? It doesn't even matter. Maybe it's a fake company. And then I go to the exchange, I post it there, and people start buying my shares, because I'm making a bunch of fake promises of how this company is going to perform. And then I just take all the money and disappear. And that's stock fraud, right? Well, there are requirements for shares to even go on the exchange in the first place, right? Such as the capital amount, right? Maybe they have $50 billion in capital. Okay, we accept you. Maybe the share has also a specific value. Your share needs to cost more than $200. If you have a $1 share, maybe we don't want it. Has to be regularly audited, which means some international company that's dedicated to this needs to go all the time and oversee the books, see what they're doing, check the company. And then a certain threshold in revenue. Maybe we want only companies that make $10 million every quarter. Otherwise, we don't want you here. And this prevents, of course, that any crappy little business, that could be fraudulent goes into an exchange and becomes a traded company, because those are technically they end up being these old penny stocks that you saw from the Wolf of Wall Street. They were just shares that were so small that they didn't even trade officially on the exchange, and people were just buying and selling them with fake promises. And in the end, it was like, I don't know, like a small tent in the woods. They didn't even have an office, that company, and people were buying and selling, thinking that's going to be $1 million company, and it was all just lies. So that's why we have requirements for shares to be listed on the exchange. And there's not just requirements for shares, there can be requirements for commodities, for everything. You will see each one of them during the later lessons. So now that we understand that, we have exchanges where people are meeting to buy and sell all the time. There's a centralized place where all the investors gather together to trade specific shares. We need to understand something else. Regardless of where you live, probably there is a stock exchange. There is famous stock exchanges all over the world. Okay, so in this case, let's talk about the New York Stock Exchange or the Nasdaq Exchange in the United States. Or you have the ASX, Australian Securities Exchange, right? Then you have the Johannesburg Stock Exchange. So if you look, slowly you'll find that everywhere in the world you have a stock exchange open and operating at a certain time, okay? And the shares of that country are being traded there. So think about it. If you're an investor, you live in the United States, and you want to trade shares of the London Stock Exchange, the one we have highlighted right now, this means you need to know what time is the London Stock Exchange open, what time do they close, and what are the shares that are being listed on that exchange. And as I was telling you in the beginning of the course, all of this information is publicly available. You can just enter into Google, shares of the London Stock Exchange, or top 100 shares of the London Stock Exchange, and you'll end up finding everything you want to know about each specific exchange. And you need to understand that each one of them operates under a specific time frame. So this means that you're not going to find open at the same time all the exchanges in the world, never. You're not going to find the Japan Exchange Group and the London Stock Exchange and the New York Stock Exchange exactly at the same time, because every country has their own time zone, right? So in the end, there is always, eventually, except on the weekends where there's a bunch of them closed, but in the end, all the time, there's someone open operating, but not all of them at the same time. And understanding what times are they open makes us see, for example, that investors are pulling hard when this exchange is just open, and then they switch to the other one after this one is closed because they want to trade on the other one, and that each country has their own assets that is trading on each exchange. Okay? Great. So let's talk about OTC. Okay? I know it sounds dodgy, but it's not. Look, OTC is over the counter, trading done off exchange. And I know I'm saying it doesn't sound dodgy. Well, it sounds dodgy, but it's not. And it's true. I'm going to explain to you why. Look, if you and I right now gather together, right, and we say, great, we're going to do some trading. No exchange, just you and me. We have our paper shares in front of each other. We have the bank accounts open to wire. Technically, that's doing an OTC transaction, okay? But the thing is that this OTC transaction, they're not happening like this. It's not just you and a friend. It's a little bit more complex than that. All these brokers that you're constantly seeing online, the CFD brokers, are OTC brokers. Why? Because CFDs are not exactly heavily regulated, standardized products. They're customizable. We're going to explore that once we look at these differences right here we have in front of us. But just let me make this clear. What I'm trying to say is that all these products that you're trading in the CFD brokers don't need to be exactly of the same way. The brokers can customize them, and they are not traded on an exchange. So this means you're trading them internally on your broker. So there can be 20 brokers, and they can be quoting different prices, regardless if they're talking about the euro dollar. They're all gonna try to match up, right? But they could be 20 different prices because they're not obliged. It doesn't work that way. They can quote whatever price they want because it's an OTC transaction. It's an internal contract they have in their system. It's not something out there publicly traded on an exchange. So the differences between exchange and OTC, let's explore the exchange as we discussed. Mandatory rules, right? So the product needs to be with certain specific conditions or needs to be traded a certain hour. Standard products, for example, if you're trading on a commodities exchange, oil or gold, each contract needs to be of 100 ounces of gold. Okay? Higher availability, of course. The big players, the governments, the institutions are all trading there, so that's where you find the money. Then more transparency, of course. If it has more rules, it has standard products and all of that, this means that it's going to be much more transparent, right? Then determines and maintains the market prices. Very important for us. So in this place where the big money is getting played around and there's people buying and selling, is where the price determination is happening, okay? And everyone out there, the CFD providers, the brokers that are quoting prices are trying to mirror the prices that are happening in the exchange because the exchange is the one responsible for these prices. And last, we say centralized structure for a reason because it's just one place. It's the exchange, this is being traded there, and that's it, period. There's not like 20 different places where you find the same asset under 20 different prices. No. Usually it's the exchange, the price, and that's it. It's being traded there. Now, on the other hand, the OTC, the CFD broker, for example, or other derivatives, which we don't care, but it's nice to know, the forwards. All these customized products have no mandatory rules, right? We can do them however we want them, where nobody's telling us how to do it. Customizable. They can have different sizes. What do you think you see when you're trading gold on your CFD broker and they tell you you can trade 0.1 contracts of gold? It's because you're trading a CFD, you're not trading gold. If you go to the biggest commodities exchanges in the world and you tell them, I want to buy 0.1 contracts of gold, they're going to tell you, goodbye, you're poor. And that's it, because it doesn't work like that. Then there is less liquidity, which means less availability. Why? Imagine, in one place you have the big players playing, right? In the other place, it's an OTC transaction. It can be a broker. Maybe it has, 1,000 people trading against each other. And in the end, there's not much money there, right? So it's less liquid, has less availability. Then, less transparency, important one. Think about this. If the exchange is transparent, it's public, and it releases all the information. This means they disclose their orders, right? How many people are buying, are selling, how much money is going up and down. In the OTC broker, they're not meant to disclose this, right? They don't care about how many people, they don't care for you to know this. It's their problem. They are quoting their own prices, and that's it. Now, the difference, okay, one of the most important ones. Okay, it's decentralized, as we told you. It has a bunch of different structures everywhere. Everyone is quoting their own price. But I want to make emphasis on this one, on lower fees. The reason that it's much, much cheaper to trade on a CFD broker is because since it's a customizable product, it's OTC, there is less volume, less size of the trades that you can execute. In the end, they can quote much, much lower fees. And when you're paying, when you're opening a trade, you don't need to pay X commission for opening a massive contract with no. If you're opening a small trade, let's say 0.1 contracts of gold, the commission you're going to pay on that is going to be much, much smaller than the commission on opening a trade of 100 ounces of gold, which if gold was a $1,500 an ounce, it can be a $150,000 operation. So in the end, the commission tends to be much, much slower. So remember, you're not trading, it's likely, it's the most probable thing to be happening. In most of the situations, you're not trading on an exchange. You're trading on an OTC broker, which can be a CFD provider. And how do they do this? Well, they're quoting the prices that are in the exchange, okay? So you technically what you're doing is trading a mirror of the exchange.